Good afternoon and welcome to our webinar, and thank you for joining us. Today's presentation focuses on the far-reaching changes to pensions. I'll shortly be handing across to Andy James, our Head of Retirement Planning. The presentation will last around 40 minutes, after which we will cover as many of your questions as we have time to do so in the time we have. If we don't get the chance to cover your question today, we'll come back to you separately from the webinar. So over to you, Andy.
Thanks very much, Paul. Yes, the pensions changes since the last budget have been very challenging for a lot of people in the industry, and we are really now looking forward to April 2015 when they actually, well, the vast majority of them come into fruition. The announcements in the budget were sent for consultation afterwards, just to make sure that the industry understood what they needed to do and were in a position to really make the changes as of April 2015. And that has certainly been a challenge to many providers out there. However, when Mr. Osborne stood up back in March last year, he did actually make some initial changes to the budget, and we want to look at those as well as the changes coming forward. So we'll look at the current position following the budget, the announcements that we've had following the various consultations that have taken place with the industry, and they have really drip-fed throughout the year. So it's been difficult necessarily for everybody to keep track of those. And then I think we want to spend some time just looking at the effect that's going to have on both retirement planning for individuals and estate planning, because there are certainly some effects on estate planning as well. And then, as Paul mentioned, we will look at the questions that we've had in and cover those off, or certainly as many as we can. Lots of stuff in the press about this over a period of time, and really the press has been quick to pick up on this, but as usual they're looking for headlines, and I think it's important to dig a bit deeper into this. I mean, there's a lot of talk about being able to buy a Ferrari with your pension, and that annuities would disappear from the retirement landscape. And I think both of those and a few others that we've seen may not quite be true. And I think it's important that people get a handle on what this really means to them. There are dangers within this. You can drain your pension, but should you? There is the potential for people to suffer large tax charges by taking their pension in one go, because you get the 25% tax-free cash, the rest of it's going to be taxed at your own marginal rate. And it's more about, I think, what you will need in retirement and utilising that flexibility within the plan, rather than just taking money as and when you need it. And I think cash flow planning for a lot of individuals will be important within this, to make sure that whatever you decide to do with your pension and other retirement money, that it's going to be sustainable throughout your lifetime. So who are we? We are a firm of chartered financial planners. We are national in the UK. We are non-transactional, which basically means that we look for fees. We don't look to sell product as such. We sell advice. We have various specialist divisions dealing with areas of financial planning, and obviously my area of expertise is retirement planning. but we have other areas of experts looking at estate planning and others. We look to invest money for our clients and are active managers of investment risk, so we look to control the level of risk taken by our clients with our investments. And we are keen to work in partnership with other professional firms, such as solicitors and accountants, to make sure that whatever solutions are put together for a client, they work in all regions of their planning. So I mentioned that we are UK-wide, and we have over 750 employees in 19 offices around the UK, and we have been advising clients in the UK for over 50 years now. We in fact have 25,000 plus clients that trust us to help them achieve their goals, and currently have over £6.5 billion worth of assets under management for our clients. And as I mentioned before, we are the firm itself is a chartered financial planner firm. So I mentioned the assets, I've mentioned the accreditations. One of the things we're very proud of is that we are part of a small panel of professional firms appointed by Camelot to provide advice for national lottery winners. So it shows the trust that Camelot and those lucky winners put in us to help them work out their finances going forward. The major ways we look to do business and our advice is really threefold. We've got the financial planning side of things for individuals, so this is where we will put together a plan that works for our individual clients to meet their needs throughout their life. Backed up with that is the support services that I've mentioned, so we have expertise in various areas that our advisors can utilise to ensure that any complex advice they're giving is right for the client. And I know they are very happy with that support they get in that front. Aligned with all that is our investment management service, where, as you've seen, we invest money for our clients and make sure again that that money is working in the right way for them and taking the right amount of risk for them to achieve their goals. And so within all of that, we look to give client value. So on to the budget legislation itself. I mentioned there were some changes that took place more or less immediately after the budget, and these were the first sort of move towards greater flexibility. There was an increase in the level of what's known as trivial commutation. Trivial commutation is just where your total pension pots that you have are relatively low, and up until the 27th of March last year, that figure was £18,000. So if you had less than £18,000 as your total pension wealth, you could actually take that amount of money out in one lump sum, and that was all. With any lump sum you take out of a pension, that's 25% tax-free cash, and the other 75% as taxable income against your marginal tax rate. Now that £18,000 was, as of the 27th of March, increased to £30,000. On top of that, there is also a separate allowance for what's known as small pots. Again, up to the 27th of March, you could take up to 2 small pots to the value of £2,000 apiece as lump sums, no matter what amounts you had in pensions. That has been increased to 3 small pots, and the small pots sum has been increased from £2,000 to £10,000. So you have there a possibility of another £30,000 worth of pensions that can be taken as lump sums. On top of that, the limit on drawdown was increased. We had before the budget a figure of what's known as 120% of GAD. GAD is the Government Actuaries Department, and they set the annuity rates for drawdown. And basically, you could take up to 120% of the annuity rate they set for your age as an income amount. That was increased to 150% as of the 27th of March. So that was a big jump in the maximum income someone could take when they were doing drawdown. And drawdown is just where you have the pension invested and it remains invested and you are just drawing in an income from it. So increased flexibility there, although that increased amount only came in on the annual anniversary someone had of commencing drawdown, so it might not have immediately kicked in on the 27th of March. On top of that, there was reduced limits for flexible drawdown. Now, the way this works is that you could enter flexible drawdown, which gives you full flexibility on the amount of money you can take out of the pension at any time, so that you're not restricted like you are in the standard form of drawdown. But to enter flexible drawdown, you had to show that you had what's known as a minimum income requirement of £20,000. Now, the minimum income requirement is based on guaranteed pension income, so that can either be coming from your final salary type pension, or it could be state benefits, or it could be annuities that you've purchased. So as long as the pension income was from a guaranteed source, it would count towards your minimum income requirement. Now that minimum income requirement, as of the 27th of March, was reduced from £20,000 to £12,000. And that certainly brought a lot more people into the realms of doing flexible drawdown, because they might have had a level of income from final salary schemes, and on top of that some income from state benefits, for instance, and therefore met the minimum income requirement. And we have certainly seen an increase in people looking for flexible drawdown throughout this year. But those changes were really minor, I would guess, when you compare that with the sort of key announcements that were made in the budget. So let's have a look at some of those. Now, the Chancellor said basically, when he stood up in Parliament, that people should be trusted with their own finances, and they should be able to access their pensions as they wish at the point of retirement. So this is pretty radical. Before that, the governments of all shapes and sizes have really looked to restrict the amount of income you can take from a pension any one year, really just to make sure that people can't run out of money throughout their lifetime. And it's always been seen that pensions were for retirement purposes, and the state was sort of being a bit of a nanny there, I guess, in a sense of saying, well, we're going to make sure you can't run out by putting restrictions on the amount of money that you can have out in any one year. So that, the Chancellor said he wanted to brush away completely. And what was announced at the time was that, firstly, all defined contribution pensions, so these are money purchase arrangements, so they're not final salary type occupational pensions. So all defined contribution pensions will be fully commutable from the age of 55. Now, fully commutable just means that you can take the money out. So anyone that reaches the age of 55 will have full access to all of their pensions on that basis. There was a further announcement that age 55 would change over time, and from 2028 that would increase to age 57, and age 57 at that time would be basically 10 years before the state retirement age, which is obviously increasing as well. And then the intention is that it will always be maintained at 10 years before the state retirement age. And as we're expecting state retirement age to increase to 68, we know about, but certainly the expectation within the industry is that it will go up to 69, 70, and maybe beyond. Then we're certainly in a position where we can expect that earliest access age for pensions to increase as well over a period of years, and may start affecting those sort of younger pension savers at this time. One of the other announcements at the time was that the Chancellor said that he felt that the tax charge on pensions on death was too high. Now that tax charge is currently 55% when you're either over the age of 75 or you've started drawing benefits from your pension. So that's a sizable tax charge for individuals receiving any pension wealth that's left over. And as I say, he mentioned at the time that he felt that was too high, and that he would consult with the industry and others on reducing that. And it was a much later in the year that we finally got the information on that, and certainly some radical changes there, and I'll cover those off as we go through this presentation. And then the other major announcement at the time of the budget was that there would be a free guidance guarantee. Now, the idea here is that anybody taking their, or looking to take their pension money will be pointed towards free guidance that's going to be available. Now, this is, it's just been announced that this is going to be called PensionWise, and it's going to be provided by the Pensions Advisory Service and Citizens Advice. Now, it can either be in the form of some online advice, or via the telephone, or face-to-face. So that will be available for individuals. What I would say is that is going to be a one-off piece of guidance, and it is only guidance, it's not advice. So it will give you the sort of things you can do and the consequences of doing those. It will not end up telling you exactly what it would recommend you to do. So do be aware of that. It's going to be useful for people just to hopefully make sure they don't make unwise decisions when taking their pensions. But I think for a lot of people, it may be well worthwhile taking advice throughout retirement, really, to make sure the decisions are correct. So what was really announced after that consultation? Well, we had some early announcements, really, pretty much after the budget, and there was going to be a new way of taking money from pensions, and that is going to be known as the Uncrystallised Funds Pension Lump Sum, UFPLS. And basically, the Uncrystallised Pensions Lump Sum enables you to take a lump sum, as you would expect, and basically that lump sum being 25% tax-free as part of your tax-free cash, and the rest taxable at your marginal rate. So, for instance, there you may have, say, £100,000 in a pension. You decide you want £10,000. What will happen is that the pension provider will take that £10,000 out. It will pay the tax on the $7,500 in that case, and pay the rest of the money to you. And obviously the other £90,000 you had in your pension will just remain untouched, and obviously you can go back and take more money out of that as and when you wish. So that's one new method. And then the other change to method, I would guess, is what's going to be known as Flexi Access Drawdown, FAD, and that's the new term for drawdown arrangements. So before these changes, we have either capped drawdown, which is where you stay within that 150% GAD limit that I mentioned, or you had flexible drawdown, which took away those limits, but you had to have the minimum income requirement. Now, with this, everybody after the 5th of April, if they go into drawdown, they will be going into Flexi Access Drawdown. And basically that will offer the full level of withdrawal flexibility. But if you take income from your pension, either via this Flexi Access Drawdown or in fact via the UFPLS, which is obviously 75% income, then you will have a reduced annual allowance of, which will be £10,000 a year. Now the current full annual allowance is £40,000 a year, so this is quite a restriction on the amount of money you can pay into pensions once you start taking an income. And this was really done to stop people taking, rather than getting paid a salary, they could say to their employer, well, I've got a £40,000 pension allowance, can you pay, rather than pay it to me, can you pay £40,000 into my pension for me? And then lo and behold, the next day I'll take it back out again, and I've got £10,000 of that is obviously tax-free cash. So it would be a way of individuals reducing their tax bill on their income. So hence this reduced annual allowance on that basis. If you're already in drawdown and you maintain your withdrawals within the old limits, i.e. that 150% GAD I mentioned, then you can maintain the £40,000 annual allowance limit. Now, you have to be in drawdown prior to the end of this tax year, so if you are thinking of doing that or might need to do that, then you'll need to do it relatively quickly. The final area of really changes is that annuities are going to have much greater levels of flexibility going forward. Under current rules, annuities cannot decrease. So they can either stay level or they can increase in value. Now, as I say, under these changes, annuities can decrease, and we will see, I'm sure, some new products coming to market over a period of time. So you may find that you'll get an annuity which will give you a higher sum in the early years of retirement, either to give you extra money to do the holidays and things like that you might do in your early part of your retirement, and then it may reduce later on as you start to maybe do a bit less of travel, etc. Or there may be an annuity which will give you higher income until your state benefits start kicking in. So I think it'll be interesting to see what actually comes to market. But I think with all these changes, it's been very difficult for annuity providers and pension providers to come up with products that are going to be ready for the 6th of April. So my expectation is that we won't necessarily see huge changes to what's available at that time, but that over the next 6-12 months maybe we will see a number of products coming to market utilising these new flexibilities. The Chancellor did say at the time that there was he was going to proceed very cautiously regarding any defined benefit schemes, and the fear there is obviously that people could move money from defined benefit pensions, which have a lot of guarantees around them, a lot of certainty around them, into final salary pensions, into money purchase pensions, whereby obviously they can get all this flexibility. And the concern there was that sometimes that might not be a sensible thing to do, but people might do it anyway. So there were various consultations that went on around that, and finally the decisions made were that there will be a restriction on transfers out of any public sector pension which is not funded. So any unfunded scheme that's out there, these would be schemes like the Teachers' Pension Scheme, the NHS Pension Scheme, etc. Transfers will not be allowed from those types of pension. Any funded public sector scheme or any other final salary pension scheme, transfers will be allowed, but it will be a requirement for someone making that transfer to take advice before doing so. The only caveat on that I've just seen recently is there may be an expectation that if you have a very small value final salary pension scheme, it may not be necessary to take advice. So that's sort of still bubbling up there at the moment. So we looked at the Treasury document, and basically it sort of gave its view of pensions at the time prior to these changes, which really showed the options that are available. And there was obviously the pension pot. You have the 25% tax-free cash, and then the way they looked at it was that if you had a very small pension under £18,000 or pensions in total under £18,000, you had the full flexibility because you could take the money out as and when you liked once you got to a certain age. On the upper end, if you had a large enough pension, you could probably finance yourself to obtain the flexible drawdown, so you could meet the minimum income requirement. And the Treasury worked out based on that you'd need something like £310,000 of a pension to be able to get the right level of income to be able to enter flexible drawdown. For most people in the middle, there was either the option for an annuity, or you could have capped drawdown. Either it's going to give you some restrictions on the amount of income you can get, or they said you could get full withdrawal, but if you did that, there was a 55% tax charge, because technically the full withdrawal under legislation was known as an unauthorised payment, and if you look at the tax rules around that, it's a 55% tax charge on that. So pretty much for the vast majority of people with pensions, a restricted marketplace as to what you could do with your pension to get income. So looking ahead, we've got a different view of pensions, I guess, and we've still got obviously the 25% tax-free cash available. But the other options really now for everybody is that obviously you can do the full withdrawal at your marginal tax rate. You can use drawdown, and that's completely flexible drawdown, so you've got no restrictions on the amount of money you can take out at any time. Or of course you can buy an annuity, and those annuities, as we've mentioned, will be more flexible. And of course you could do a mix and match within that, whatever makes sense for you. Certainly I think over a period of years, a lot of people may well be looking to sort of de-risk their income strategy. So you might start off maybe just withdrawing a few lumps of money out of your pension to cover some credit card bills or something that you have, and then over a period of time you may start then drawing income directly from the pension pot to cover obviously your retirement needs and the holidays, etc., etc. So you probably want a level of flexibility there in the early years to make sure that you can take more out one year than another. But for a lot of people over a period of time, they're probably going to want a level of certainty about their income, or at least some of their income, and may therefore move towards the annuity as they get older. There's quite a possibility here that whereas currently annuity purchases tend to be people in their 60s, they may well move out to people in their 70s or even 80s as time goes on. But really around all of this, there's going to be a need to do tax planning, because if you make the wrong decisions, you can end up paying a lot more tax than you need to. And the tax planning really needs to take out not just your pension assets, but obviously any other savings and investments that you've got, just to make sure you're utilising them in the most tax efficient way to give you the highest income you can get without paying too much tax on it. So obviously the less tax you pay, the easier it is to make your money last throughout your retirement. So I think a lot of the planning will be around that over the retirement years. And to give you an idea, I mean, if you blend wrappers for retirement, you can create that flexibility and combat the unknowns. I mean, one thing we are seeing is lots of changes to pension rules, but also lots of changes to allowances with other investments as well. So I think if you have the flexibility there, you can chop and change as you need over a period of time to make sure you're utilising the right investments at the right time to keep the tax as low as sensible. So let's have a look at one example you could have of how you might build retirement income if you've got various investment wrappers. So, for instance, you could take £10,000 income from your from either pensions or maybe it's rental income or whatever, but you've actually got income. Now, £10,000 income is actually within the your personal allowance, so that is therefore not taxable on that basis. You may then take maybe some tax-free cash from your pension, and obviously under Flexi Access Drawdown, you could you can take that tax-free cash as and when you need it. So that's a way of accessing money without paying tax on it. Then maybe you take some money from capital, and again within the realms of capital, you have an annual capital gains allowance of £11,000 a year, so you can take money out of your investments, and as long as you maintain the gains within your annual allowance, again it's tax-free. So again, we've got £20,000 coming out of capital there within the capital gains allowance. And then maybe you could take £20,000 from your ISA, and of course money coming out of ISAs are tax-free as well. So that gives you another form of income in the wider sense of the word to give you money that you might need. And then perhaps you've got some insurance bonds out there, and you might look to encash those while you're at least a basic rate taxpayer, so you've not got any further tax consequences of taking money like that. So planning all that out there, you would end up, in fact, in this case, with an income of, income, I say in the widest sense of the word, income and capital of £100,000, and you've not paid a penny of tax on that. And there's going to be no issues with the HMRC because that's all standard tax planning that you can do. So it does give you massive opportunities here to be very tax efficient in how you take income in your retirement. Now, the other announcement we got later in the year was about the death benefits after this consultation, and they were certainly very wide as well, and certainly more far-reaching than many people in the industry was actually expecting. So currently, these are the rules. Now we've got there's different rules before age 75 and post age 75. So before age 75, under current rules, it depends whether you have crystallised your pension or not. Now, an uncrystallised pension is basically a pension that where you haven't taken any benefits from it. Crystallised means you've either taken tax-free cash and or some income from your pension. So if before the age of 75, if you're uncrystallised, so you've not taken anything out of your pension, basically you could leave a lump sum to anybody you nominated by that pension, and there's no tax charge on it. You could actually leave a pension to a dependent, but I mean basically if you can leave a lump sum tax-free, then that's what people are going to do. So for 75, uncrystallised pension, money can be paid to anybody you nominate tax-free. Once you crystallise that pension, so once you've started taking those benefits, we start to see tax charges. If the money is paid out as a lump sum, it can go to any beneficiary, but that lump sum is going to be taxed at 55%, so a very sizable tax charge. You can also, with a crystallised pension, pay the money across as a pension to your dependents. They have to be dependents, not just any beneficiary. So that would be a spouse or a dependent child. And any withdrawals that then come from that pension is taxed at their marginal tax rate. So they would pay basically income tax on withdrawals. So that's current rules before age 75. Over age 75, somewhat simplified rules really, but it doesn't matter whether you crystallise your pension then or it's uncrystallised. It's the same rules, and basically any lump sum paid out can go to any beneficiary, but we've got that 55% tax charge. Or you can leave the pension to your dependent at that marginal tax rate. So that's the rules after age 75. So the new rules, we've still got this age 75 there, and nobody's quite sure why it's age 75 or anything, but it's there for the time being at least. And basically, under the new rules, doesn't matter whether you crystallise your pension or it's uncrystallised, it's the same outcome with you can either pay the money across as a lump sum or as a pension to any beneficiary, and either way that beneficiary will not pay any tax on either the lump sum or any income they take from that pension. So very much freed up death benefits on death before age 75. Post age 75, again, very much more simplified. Doesn't matter whether you crystallise or uncrystallised. If you pay a lump sum or a pension, it can go to any beneficiary, but in this case it will be taxed at their marginal tax rate as and when they withdraw money from the pension. In the first year, any lump sum paid is actually going to be taxed at 45% because of the difficulties pension providers have with just sorting out that marginal tax rate, but the intention long term is that it would be paid out based on the marginal tax rate of the individual receiving the pension. Now, those are pretty radical changes anyway, but on top of that, there is the potential for that beneficiary who receives the pension, if they've kept it in the pension and they haven't withdrawn all the money at the time of their death, then they can pass it on to people they nominate. And again, if they die before the age of 75, it gets passed on tax-free, and if they die over the age of 75, it's passed on as a taxable amount as and when it's withdrawn. But this does open up the possibility for pensions to pass down the generations if they're not needed for covering retirement income. So big changes there, and certainly it turns on its head really the thoughts around pensions, because before, with the 55% tax charge on pensions, people were utilising their pensions to before they utilised their other assets, which potentially under inheritance tax rules would only get charged at 40%. Now it would seem that it may well be worth utilising your other assets in your estate first and leaving the pension until at least until later, so that you can pass that pension wealth on to children, grandchildren, etc. So interesting changes there, and certainly lots of considerations. Anyone that's done any previous estate planning work might want to re-look at that, I guess, at this stage. And these rules, whilst they technically come in from the next tax year, because the rules are based on the date of payment of the death benefits, not the date of death, then all you need to do is delay payment of the death benefit until the next tax year, and it will come out under these new rules. So these rules are basically available now. So I mentioned before the guidance guarantee, and the Chancellor said that he would offer this free, impartial, face-to-face. He actually said advice when he stood up in Parliament, but it very quickly got changed to guidance when the Treasury put their documents out afterwards. The difference being, of course, you can be sued for advice, you can't actually be sued for guidance. And he set aside £20 million just to get it set up, and I've mentioned how it's going to be set up now. But the industry is going to end up funding the cost of giving this guidance going forward. So it is another cost on the industry. And it will be interesting to see how that pans out over the next 12, 18 months. So I think that there are lots of decisions to be made on pensions, and the decisions are really at the point of retirement and beyond, really. So there's things about, how much cash do you actually need out of your pension pot? How much income are you going to need now and in the future? Does it need to be flexible, or do you want some security with it? A big question, of course, is have you saved enough in the first place? Because it's all about, when can you afford to take the benefits? When can you afford to retire? And certainly for people with larger amounts of money in their pensions, there's going to be this question around, well, actually, should I just leave my pension alone and just leave it to my heirs, because it's a very tax-efficient way of passing money on? And I think with the guidance, you're going to get a one-off piece of guidance, but as I mentioned before, this is really about long-term planning. People in retirement these days are likely to be in retirement for 20, 30, even 40 years. So there is a need to plan long-term, and the likelihood is that people's needs and objectives will change over a period of time. So I think ongoing advice is going to be important. In the early years, maybe even before you actually retire, there may be a wish to access your pension just for a bit of cash to cover bills, pay off the mortgage, etc., that sort of thing, almost pre-retirement planning. After that, when you get into retirement, you might look to draw income, but you might well want some sort of level of flexibility within that, because there's holidays to pay for, there's maybe change your car every few years or whatever. So a level of flexibility in the amount you would draw would be sensible. Then we might, later on look at being a bit more secure with the income, take any tax-free cash that's left in the pot, and maybe we're looking to buy an annuity for some or all of our income to at least perhaps make sure that we've got enough money to cover the gas bill when it comes in, etc. So it really will be a retirement journey, and people's needs and the advice that goes with those needs will, I'm sure, change as people get older. So, questions, Paul?
Thanks, Andy. Obviously a lot of interest in this area at the moment, so we have quite a few questions for you. So our first one relates to a husband and wife, and I'll just read out the question. So my wife and I may be interested in using our SIPs to provide funds in the future for current and the future grandchildren, and in particular to help them with university education. What do we need to set up in terms of the appropriate structures within our SIPs?
Thanks, Paul. Yes, I mean, that's certainly an opportunity with these new rules. So basically, with any pension, not just a SIP, you will need to fill out what's known as a nomination form. So there you can nominate one or a number of people to receive your pension. So you could split it, so much to a spouse, so much to children, so much to grandchildren, etc. Now, a nomination is basically a request to the administrator of the pension to pay out money in that format. The administrator actually has the final say as to how the money is paid out, because pensions are set up under discretionary trust arrangements, basically, and that way they stay outside of somebody's estate, so that discretion is maintained by the administrator. Having said that, unless there are real extenuating circumstances, the administrator is going to abide by any nomination they receive. So all you would do there is obviously nominate your grandchildren in that case to receive the pension on your death, or certainly part of your pension. I mean, I suppose the only issue there is you're obviously never quite sure when you're going to die, so I'm not sure if the money would go to them soon enough to cover their estate, their university fees. Having said that, of course, you can change these nominations at any time, so you could put a nomination in there to do that, and then if circumstances change later on, you can change your nomination. So it is very flexible. Just need to make sure you're keeping those nominations up to date.
Thanks, Andy. Quite a complicated question, this next one, into many parts. So if you're going to take advantage of the 25% tax-free payment and put your pension into drawdown, is it better to do this before or after the April changes? And linked to this, what are the financial or tax implications? And can you continue to pay into drawdown after taking the tax-free payment in both cases?
Right. I'll try and pick those up. The only advantage of going to drawdown prior to the end of this tax year, as I mentioned, is really that you can maintain that £40,000 annual allowance amount. So as long as you then keep your income within the 150% of GAD, you will have the £40,000 annual allowance limit. So if you think you might need to pay more than £10,000 into a pension, you might want to consider doing that. If, however, you go into drawdown after the 5th of April, you will obviously, of course, enter Flexi Access drawdown. You can still actually take tax-free cash from that pension and maintain your £40,000 annual allowance. So it's only when you take income that you're going to lose that £40,000 allowance. But certainly within those annual allowances, you can continue to pay money into a pension once you've started drawing benefits from it.
Thanks, Andy. We have a question here about occupational pension schemes. Will people who have an occupational pension scheme or several schemes be able to consolidate and manage them easier, say, in a personal SIP?
Yes, I mean, that's certainly possible to do. Now, I mentioned before that there would be a requirement to take advice on those pensions if they are, if their value is above a certain limit. I think the limit's going to probably end up at £30,000. That's what seems to be mooted out there at the moment. So if they're worth more than £30,000, or any of them are worth more than £30,000, you will need to take advice from a suitably qualified financial advisor before you transfer, and the receiver of that pension will be checking to make sure you've had that advice. So obviously, yes, based on that advice, it is certainly possible to transfer to gain all these flexibilities. Whether that's a sensible thing to do or not is another matter, of course, because, as I mentioned before, final salary pensions do have a great deal of guarantees involved in them, and all the sort of risk around providing those guarantees are taken by the employer, not you as an individual. So it is a big decision to come out of a final salary pension scheme, and I would certainly err on caution there before you actually go ahead and do that.
Thanks, Andy. And again, this is related to final salary schemes. Will the legislation have any bearing on these, and especially in terms of the commutation rates into tax-free lump sums? I suspect not, as far as commutation rates go. Couldn't say for certain, but I doubt that it's going to impact on that. And really, this legislation doesn't touch final salary pensions, but of course it does open up the possibility of moving that final salary pension to, you know, a personal pension type arrangement to gain these flexibilities. So, whilst, you know, not immediately affected, they could be on that basis. Thanks, Andy. A question around somebody approaching retirement. So I'm nearing retirement. Does it make financial sense to feed my pension account from my investments, and then on retirement to feed my investments from my pension account, assuming I don't need to draw any pension?
Well, that's an interesting question, and certainly I would say there that you know, before you do anything, you would need individual advice, because much of this is going to depend on your own tax position and your own objectives. But certainly it is a consideration to be gaining tax relief, putting money into pension, and then obviously 25% of that could come out at a later date tax-free, and the rest is obviously taxable at your marginal rate at the time. So again, if you're paying higher rates of tax while you're working, you expect to pay lower rates of tax when you're retired, it's certainly something to consider.
Thanks, Andy. A question around the new types of products that we might foreseeably see in the future. We have a question about what new products can deliver the predictability that annuities gave, so that pensioners can plan their retirements with financial confidence.
Well, yes, as I mentioned before, I think we may be waiting a while to see what new products come to market. I mean, the annuities are still there, and I mean the newspaper headlines about the death of annuities, wasn't really strictly correct. So you can still go and buy an annuity now, which will give you the guaranteed income for life, and certainly for people looking for security, that's something to consider. I very much suspect there will be new products coming to market, and some of them will offer certain levels of security. Exactly what we'll see, I'm not sure. And the other side of it is, of course, when you're looking at that sort of product, is to see what you're paying for that level of security. So it is horses for courses.
Thanks, Andy. What's the position if I have already taken 25% tax-free cash, and I'm currently I'm currently using drawdown to fund a pension?
Well, as I say, if you're already in drawdown, you can remain within the current tax drawdown limits if you so wish. That will keep you maintaining that £40,000 annual allowance. So if you don't make withdrawals above 150% of that GAD rate, then you're fine. However, if you're in capped drawdown, as it's known, there is nothing to stop you taking more money out. It will just mean that you will automatically move over to this new Flexi Access drawdown. The only caveat I would put on that is that anybody going into Flexi Access drawdown and then being affected by this reduced annual allowance of £10,000 needs to ensure that they have informed all of their pension providers that has happened. So if you've got more than one pension, you do need to make sure that the other pension providers you've got are aware that your annual allowance has been reduced to £10,000, and there are potentially fines in place for not advising those other pension providers. So one to watch out for there.
Thanks, Andy. You may have covered this in your presentation earlier. I think you did actually, but just for completeness, we have a question around when the policy changed. When the pension changes were first announced, I recall there being a requirement for someone to have a minimum income requirement, including state pension, of £12,000. Has this been dropped?
Yes, so currently that £12,000 limit is there, but for this tax year only. So once we move into the new tax year and we have the Flexi Access drawdown, there is no requirement for any sources of income prior to the complete flexibility being available.
Thanks, Andy. We have a few questions around the security aspects, I guess, after the new changes for pensioners. So under the new flexible pension system, how secure will the capital be with different providers?
Well, pensions are covered under the Financial Services Compensation Scheme, so I think there is a sensible backup there should there be any issues with providers. But I don't really think the new rules affect the capital positions that much of our insurance companies in the UK. So I don't really think there's any sort of huge change, or I can't really see any massive concerns about why this would make the situation any worse, put it that way.
And to your knowledge, are pension providers legally obliged to release funds after April?
In the sense that under the contract you have with them, they are obliged to release funds. I mean, each pension you've taken out is a contract with that provider, so there may be certain clauses within that might give you a level of restrictions that you need to be careful of. So it is worth checking with your provider. Having said that, you would always have the option to transfer somewhere else to gain flexibility if that provider couldn't give you that flexibility within the arrangement that you had. So you just have a discussion with that provider.
Thanks, Andy. One of our attendees is asking about a small pension that they have, which is about to mature. As I still have a mortgage, which I'd like to pay off, what's the most tax-efficient way to take this money?
Well, certainly, I mean, obviously you've got the 25% tax-free cash. I mean, the major issue there is how much tax you're going to pay on the rest. So, and that obviously depends on your other income you have in the tax year. But certainly, obviously you've got a mortgage to pay off, so you need to do that at some stage. But do consider whether it's going to be beneficial to at least perhaps take the pension over maybe 2 tax years, to whether that might reduce your the tax you'll pay on it. But again, I would recommend taking advice just to make sure you're not paying any more tax than you need to. And
a question about whether people can pass their pension costs on to relatives.
Yes, I mean, as we really covered within that presentation, I mean, it's not just relatives. In fact, you can pass a pension on to anybody. So, if it's your best mate down the road, then you can nominate them to receive the pension. So it can pass on as just the same on those tax rules that we've got there.
Thanks, Andy. And I guess one final question. Can you take the full 25% tax-free lump sum at age 55, but have no income keeping the rest of the fund invested?
Absolutely you can, yes. And I think quite a few people might well be doing that in the early stages. So just take either all your tax-free cash in one go or over a period of years, but obviously making sure that you're not paying any income tax on that. And certainly if you've got other earnings that are coming in, that may well be a sensible way of planning the early parts of your retirement.
That's great. So Andy, I think you were just going to do a quick summary slide on the next slide, if that's okay.
Yep, I'll cover that. Thank you. So as we cover through all that, some of the changes that we saw were immediate, and some were really proposed to take effect from April this year. The immediate changes were, tweaks on the flexibility just to make things a bit more flexible than they were before. But these massive proposals that were made at the last budget did need consultation, because they were that big that the industry needed to be ready for them, and the government needs to ensure that whatever they put through, the industry will be able to deliver. The final outcome, we've had a drip feed of information throughout the year, but it's now largely clear, I would say, although the final bits of legislation are still passing through Parliament. But really we have a very different pension landscape going forward, and certainly some real opportunities for people to do more tax planning and maybe some more estate planning with their pensions than they've done in the past. But I think the point is that the greater flexibility with these pensions does put the onus on the individual, and there is greater responsibility from that individual to make sure that whatever they're doing is sustainable over the long term.
Andy, on behalf of us and everybody, thank you very much for your time and your thoughts. And thank you again for everybody for joining us online. If you have any further questions or would like to speak to one of our advisors about your retirement planning, please email us at webinars@towery.com. We'll leave that on the last slide on the presentation, and we'll be delighted to see if we can help you. Many thanks and enjoy your day.